RBI eases risk weights. Is it not a big boost for banks, NBFCs, and the markets? The Reserve Bank of India has eased risk weightage rules, and this is a game changer not only for the banks, NBFCs, but also for the home buyers and especially for your portfolio. Markets love liquidity, and this move signals a major credit expansion. Let's break it all down. What this means for your investments, how sectors will react, and how you should invest and what you should do next. Hi, this is Prabhanjan Rao from Elysian Investment Advisory. We are a SEBI registered investment advisory providing curated solutions for long-term wealth creation, retirement planning, lifestyle planning, last but not the least, estate planning. So, stock market enthusiasts, what we will cover today is why this is a big deal. What exactly happened? That means key RBI announcements. Why did RBI make this move? We understand the credit slowdown and how RBI tries to improvise the situation. How does this impact NBFCs and microfinance institutions? Those are all called as NBFCs and MFIs. A quick explainer. What are risk weights? Who benefits from this move? That means we study the key sectors and the stocks to watch. Why this matters to investors? We also understand market impact and growth potential. Why this move by the Reserve Bank of India is a very big deal indeed. Reserve Bank of India easing these weightage rules is indeed a big deal for banks, NBFCs, MFIs, which we typically call it as microfinance institutions, home buyers, and your personal portfolio, because it helps in inducing more liquidity and easier loans. What is the effect? Banking stocks, NBFCs, MFI stocks set to benefit. Now let's understand, what did RBI do? The RBI has reduced risk weightage on loans to NBFCs and MFIs, making banking lending very easier. This will take effect from April 1st, 2025. Here is how RBI has been pumping liquidity into the system. On December 9, 2024, CRR, the cash reserve ratio, has been cut by 50 basis points, releasing 1.13 INR lakh crore into the economy. This is the first CRR cut in 5 years. Since January 1st, 2025, RBI has conducted 1.38 lakh crore worth of open market operations, which we typically call it as OMOs, to inject liquidity. On January 28, 2025, $5 billion worth of FX swap, injecting 43,000 crore into the banking system. On February 28, 2025, RBI plans another $10 billion forex swap, adding 1.38 lakh crore more. Daily repo operations have resumed, another strong liquidity boost. Eased prepayment penalties to encourage MSME borrowing. What does this all mean to us? More liquidity, and more liquidity. Also, lower lending costs and potential interest rate reductions. This is a clear shift towards supporting credit growth. Why did RBI do this? Let's rewind. In November 2023, RBI raised risk weights on loans to NBFCs and MFIs by 25 percentage points. Why? To slow down unsecured lending that was growing at a scorching pace. But here's what happened. Bank loan growth crashed to just 6.7% in 2024 compared to 15% in 2023. MFI loan disbursements fell by 36% in Q4 2024, a 2-year low. NBFCs turned to costly external borrowings, that is ECBs, bonds, etc., making more making loans more expensive. Now, RBI is reversing the course to kickstart their credit growth, ensuring NBFCs, MSMEs, and homebuyers get access to funds more easily. How does this impact NBFCs and MFIs? For NBFCs, the risk weights return to pre-November 2023 levels aligned with external credit ratings. Easier access to bank funds, meaning lower cost of capital for them. And what it means for microfinance institutions, loans under regulatory retail portfolio will now carry a 75% or 100% risk weight. Earlier it was 125%. Consumer loans for personal use will have a 100% risk weight instead of 125% earlier, making it easier for banks to lend. So, more clarity for banks is equal to more lending to NBFCs and MFIs is equal to stronger credit growth. Viewers, we have been talking about risk weights all throughout this video. Now let's understand what are risk weights, because understanding the risk weights is the key for the investors. Risk weights determine how much capital a bank must set aside against a loan. Higher risk weight means banks need more capital, so lending slows down. Lower risk weight means bank can lend more with less capital buffer. RBI move reduces the safety margin that the bank needs, freeing up funds to lend. This boosts not only the credit flow, but also it makes loans more cheaper for business and individuals. Who benefits from this move? The decision by the RBI is a big game changer for several key players, and here is how. For banks, low capital requirement means better return on equity and higher profitability. For NBFCs, easier, cheaper borrowing helps them to expand lending without turning to expensive external sources. Earlier, they had resorted to external commercial borrowings. For home buyers, if home loan gets lower risk weights, interest rates may drop, boosting demand for affordable housing. What are the key sectors which could be benefited by this RBI move? Obviously, real estate, infrastructure, and MSMEs, they could see much faster credit growth as banks lend more freely. What is the potential impact on the sectors? Banking and NBFC stocks. More lending equal to more profits. Real estate and housing finance companies. Easier home loans is equal to more demand. Infrastructure and MSMEs. Better funding, which will boost the growth. Why this matters to investors? This is an important moment for the investors, and here is why. Banking stocks benefit. Higher profitability due to lower capital needs. Credit growth drives re-ratings amongst NBFCs, microfinance stocks, and they could potentially rally. Strong liquidity equals to market expansion. Pro-growth signals from RBI boost investor confidence. What should smart investors do now? At Elysian Investment Advisory, we follow the following strategy. Stay invested in high-quality banks. Accumulate NBFC leaders. Don't panic sell. Use dips to accumulate. Stick to well-governed companies. RBI has opened the liquidity taps. Now it's your turn to position yourself smartly. Want to know which sectors we are adding to our clients at Elysian? Subscribe to our channel for more market insights. Like, comment, and share this video. Book a call with us today for a custom investment plan. Markets reward those who stay ahead. Make sure you are one among them. Have an Elysian day.